Dr. Bohanon, how does the economy look?
Well, at the end of the year, I think we're looking all right. I think the key word for the American economy in 1987 has been nervousness. And I think that's what we're going to go into in 88. We're not in any collapse or decline yet, but everybody has the feeling of, oh, there might be some impending doom. There might not be some impending doom. We don't know.
Can we talk ourselves into these things? For example, we hear about inflation. We hear about a recession. Does all this talk affect these situations?
I'd argue that there's some psychological effect that, as you say, becomes a self-fulfilling prophecy. That certainly can occur. I'm not sure if that's the dominant effect. There are other things, obviously, quote, real variables will in the long run influence things more than, quote, psychological variables. But certainly in the short run there can be influences. And if all consumers decide things are lousy and they stop spending, then things become lousy because of that.
We hear that a little recession, a little inflation is not bad.
Well, it's like anything else that's bad. I mean, if you had a choice between typhoid and pneumonia, which would you take? I suppose you'd rather have a mild case of each than to have a severe case of either one of the two. But my prognostication is I think we're probably going to be going into an inflationary period that may be more severe than what we'd like to live with. I think right now the economy is at the risk. The big risk is one of inflation. Of course, if inflation could be accompanied with recession, then we'd have the worst of both worlds. But right now, I think the risk is going to be one of inflation.
Usually they don't go together.
Usually not. Usually the beginning of an inflationary period will be consistent with a certain degree of prosperity. If you have persistent high rates of inflation for continual periods of time, this can be accompanied with a recession simply because people get used to the inflation, and the kick of higher prices in the economy tend to stimulate things no longer works. That's why I think the trade-off between inflation and unemployment, or the trade-off between inflation and recession, nowhere near as profound in the 1980s as it was in the 60s or the 50s, because people simply have learned that high rates of inflation don't necessarily lead to high levels of output, and to the extent they expect that, they see high rates of inflation, they don't change their behavior, increase output, or do anything like that.
If we had a choice, and I don't know that we do, which is worse, inflation or
Boy, that's a
recession?
hard one. That's a hard one to consider. I'd say, from my perspective, I'm willing to risk a little bit of inflation now. It may be the medicine we absolutely have to have. For example, take the infamous stock market crash of October 19th. If the Federal Reserve had followed after that a tight money policy, you very well could have had the conditions for 1929 reemerging. Remember in 29 what happened is the stock market crashed, confidence was shaken, and then at the same time the Federal Reserve managed to contract the money supply. They made money tighter, made it more difficult for businesses and consumers to go out and borrow funds, and that sort of added fuel to the fire.
But the Fed loosened up this time.
But the Fed loosened this time, and I think it's primarily because everyone in economics and business circles knew that that was the appropriate thing to do when you're in a position of a great deal of inconfidence, when there was a loss of confidence in the economy because of the stock market crash. The problem is that sets the seeds for potential inflation episodes in future periods. That's bad, but I think the alternative of a stock market crash followed by tightened money and a recession would have been a lot worse. A little bit of inflation. I hate to sound like a little bit of inflation is not too much of a problem because it sounds like a little bit of pregnancy is not too much of a problem. It's sort of the same kind of argument. Where does it stop in terms of its impact? But I think most of us would be willing to take some of the risk associated with inflation compared to trying to go down the recessionary path. Now, we may have to go down a recession anyway, I don't know. But if we could keep money loose and allow other things in the economy to work their way out, we may well be able to avoid the worst of both worlds.
In comparing the Fed, the Greenspan period with the Volcker period, which do you think is going to be the most effective, or has Greenspan been in long enough?
It's hard to say because Alan Greenspan hasn't been in there long enough to really make a crucial assessment as to what he's going to end up doing. I think at this point he's acted about the way Volcker would have. He's been fairly responsible. He obviously is knowledgeable of monetary theory. He obviously knows the kinds of things that are good and bad for managing economies. He's not Paul Volcker, though. And that's, again, back to the very first thing we were discussing, the psychology of these kinds of things. Obviously, Volcker was a very calming influence, to a lot of markets internationally, and Greenspan just doesn't have that stature yet.
Right. Volcker had been in through several administrations.
Sure, and also he had credibility. The thing that was good about Volcker is in '79 he said, I'm going to stop the growth rate of the money supply, and he did, and he followed that all the way through, and people believed him when he said things. You're not sure what Alan Greenspan's going to do.
Volcker had the confidence of both parties, Republicans
That's
and
right,
Democrats.
and also crucially of international markets. The big thing that's interesting on financial circles now is to see what's happening with the dollar. I don't think anyone has any confidence as to what the future value of the dollar is going to be vis-a-vis other currencies. I think most of us believe that the dollar is going to decline. The question becomes, at what rate is it going to decline, and how serious is the administration, the Federal Reserve, about trying to prop up the dollar? It's been pretty obvious in the last few weeks that no one's really serious about wanting to maintain the value of the dollar.
How serious to our overall well-being is a low dollar? For example, I know that our goods are more desirable with a low dollar
Sure.
overseas, so it's going to stimulate the local economy, but also there's adverse effects to it, too.
Absolutely, absolutely. I mean, the low dollar is really a mixed blessing. In one sense, if we're going into a recession, the thing we need to do is have some kick in terms of spending for American factories and American businesses. And this is exactly what the low dollar provides. That's exactly what has happened. Even though the trade deficit news doesn't appear to be good, one of the things that often gets lost in an analysis of the statistics associated with the trade deficit is the fact American exports are up dramatically. American exports are up at the rate of 10 to 20% a year in the last calendar year. Well, that's an enormous shot in the arm for an economy that's risking recession, or an economy, well, let's say, where consumers are beginning to have some queasiness about going on and continuing to engage in spending. So that's the good side of the low dollar, is it does in some sense restore American industry. It does in some sense provide a Keynesian stimulus for aggregate demand that sort of is a recession antidote, and that's good. The bad news about the dollar is, quite obviously, it lowers our standard of living. If we have to pay more for goods that we import, and we have to send more of our products overseas to pay for the goods we import, what happens, after all gets said and done, we have less to consume domestically. And if we're concerned about our standard of living, I think every viewer in the audience and everyone at Ball State, everyone I know, is in the final analysis concerned about their standard of living. If we have to pay more for imports, our standard of living inevitably goes down. That's the bad news. Again, to the extent foreign goods go up in their cost, this puts less pressure on domestic producers to hold the line in terms of their prices. So the flip side of that, the way that the decline of the standard of living is manifested through a decline in the value of the dollar, is by higher prices for everything. And that's, again, the declining in the value of the dollar, that's inevitable. It's inevitable some inflation follows that.
And we are so dependent on imports, whereas formerly 20, 30 years ago we were not. So that would not have had the effect that it'll have
Well,
now.
that's probably right. It's interesting, at an international level, we're still one of the more independent countries with respect to imports. We're a very large integrated national market. Countries like Belgium, even countries like Japan or South Korea are much more dependent upon the import-export market than we are. But you're absolutely right, the world has become a smaller place. Now, in the short run, that might seem to be something that's bad. It makes us vulnerable to foreigners. But we have to remember that in the long run, that has been the foundation for the increase in the standard of living around the world, is increased interdependency. One of the things I like to tell my students, or give them as sort of food for thought, so consider the circumstance. What would happen if the only thing we could consume in Indiana were Indiana products, and we couldn't buy things from Ohio, Michigan?
Be very limited, wouldn't
We'd be very limited.
Yeah.
Now, in some sense, people think, well, we become an independent state. We'd have a certain sense of self-autonomy and self-sufficiency. And okay, that might be right, but we'd have an enormous decline in our standard of living if we couldn't consume Texas oil and Florida oranges, or if we could only consume those products at prohibitive cost.
So the interchange between countries is advantageous to everyone.
In the long run, that's absolutely correct, because it wouldn't happen otherwise.
The better off they are, the better off everyone is.
Sure, and that's something that often gets lost in the policy discussion. We tend to think of our gains as being their losses and their gains as being our losses. Where the fact of the matter is, marketplaces lead to mutual gains for both parties involved.
With our low rate of inflation and fairly stable economy, with the exception of the jerks in the market in the last few months, Would you say that the Reagan administration has done well as far as economic stewarding?
If I was going to grade the Reagan administration, I think I'd give them somewhere in the B range. I'm not sure if it's the high B range or the low B range.
Well, that's pretty good.
It's pretty good. There's been some things that I think lack desirability. I'm not so sure. I think the big contribution of the Reagan administration historically will be the reductions in marginal tax rates. In the long run, that provides a basis for long-run incentives in the economy. And that's something that I think is irreplaceable. I don't think there's any way you can get around that incentive effect that emanates from having lower corporate and individual tax rates. And that's great.
We also have one of our lowest unemployment rates since the war years.
Sure.
Lowest inflation rates. I mean,
sure.
But of course we do have our national debt, which...
Right. And that gets to the thing where Reagan, I think, is coming closer to the B minus range, which is the question of the deficit. I mean, there's no question that the cut in the tax rates, that again, as I argue, will have long-run benefits to the economy. The long run will lead to more capital formation, more productive use of existing capital stock, all the things that are necessary to give us a high standard of living in future periods. The flip side of that is we haven't gotten spending under control. If tax rate cuts were accompanied with appropriate cuts in spending, appropriate reductions in just the growth rate of the size of the federal federal budget, we'd be in pretty good shape. But the high deficits are something to be of some concern.
Let's talk about gold for a minute. And as we talk today with this interview, gold went over $500 an ounce for the first time in 5 years.
Right.
We on another spiral. What does this indicate?
Well, I'd argue that the price of gold really reflects a market compilation of expectations about future inflation rates. So that when the price of gold goes up, that's the marketplace saying we think there's going to be some more inflation in the future. And again, that's consistent with what we see. The Federal Reserve is not in a position of being able to clamp down the growth rate of the money supply. Given the stock market crash and given the other things that are going on in the economy, the Federal Reserve simply can't clamp down the money supply. To the extent we have to have a lower dollar in order to eventually lead to some kind of balanced trade, the Federal Reserve can't clamp down the money supply. And to the extent Congress isn't going to get too serious about cutting back government spending, or don't appear to be doing a really very good job on that, what's going to happen? The Fed can't afford to cut down the growth rate of the money supply. So inevitably, we have all those dollars floating around. That's got to lead to higher inflation. I think that's what the price of gold's telling us.
So gold and tangible investments, antiques, art, and precious metals are a hedge against inflation, aren't they?
Sure.
Would you advise, or let me ask you, rather than put words in your mouth, what would be the advice as far as investment goes for a person that has a few $1,000s? Where would you put it?
Well, personally, I've been putting my wealth, what little I have of it, into durable goods and short-term financial assets.
And such as,
well, Persian rugs and quick bank deposits, things like that are quickly liquid. And I think that's typical. That's the typical kind of thing that's going to happen in an inflationary period. And that would be the thing that's unquestionably what economists would advise. That the thing to do in an inflationary period would be to have some kind of liquidity have some kind of premium on liquidity, and in addition, put your resources in durable goods because they will maintain some value.
Good. Thank you so much.
That'd be it.